Your clients have pre-tax money, tax-deferred money, after-tax money. How do they coordinate it all to get the maximum benefit? Well, Steve from LifeYield is going to tell us how. Hey everyone, I'm Bill Winterberg of FBPad.com. Thank you for joining me for this software demo. We're going to see LifeYield, and joining me to do that is Steve Zushin.
Thanks for having me, Bill.
Thank you so much. So,
Absolutely.
To get right started off on the right foot, tell us about what LifeYield is and how financial advisors can use that in their business as they work through tax planning strategies with their clients.
Yeah, absolutely. So what we're aiming to do at LifeYield is really help advisors illustrate to their clients how they're helping them make and keep more of their money. So as Bill stated, we have clients with a lot of different types of accounts, qualified, non-qualified, tax-free. That list is really growing every single year, right?
It seems like Congress keeps adding the types of accounts and tax ramifications with those accounts year after year.
Absolutely. And then you layer on things like when certain funds can be accessed in retirement. You have when you can file for Social Security, which it offers quite a wide window for people that confuses them. And then how do they use their assets and coordinate it all together? So what LifeYield's done is we've created this software to help advisors visualize those benefits for clients and really where they're going to add value in being a resource for that client to coordinate all of these different things to get the best possible outcome.
So I hear a couple of strategies with that. I hear when you get introduced to a prospect for the first time, you can do some proposals, maybe some back of the envelope illustrations to see where are you today and are there some opportunities today to increase your after-tax income. But even for existing clients, year after year, or as new strategies or new accounts are made eligible, or the client gets closer and closer to Social Security, as you said, advisors can actively work with existing clients to run through these illustrations. So it's both something the advisor can use before they create a formal engagement with a client, and then something they can use ongoing with clients year after year.
Yeah, absolutely. So you raised a good point. Even with getting close to Social Security, let's talk about that for a minute. Right now, we have an unprecedented amount of people retiring, right? All the baby boomers are coming up on or already getting to their retirement age. Now, I don't know of any financial advisors that are really fumbling over themselves to go out and help someone run a Social Security plan. But these baby boomers, there are a tremendous amount of them who have never sought financial advice, never sought help from a financial professional in their entire careers. And they've built their entire career using qualified accounts, and now they are seeking advice for the very first time to get help with Social Security. Now they're actually a pretty good client and a pretty good prospect. There's a lot of opportunity for rollovers. A lot of these 401ks are going to be closed, and they're going to need help managing their assets, and they might have well over $1 million now. So that's a really good prospect. So if I could open the door with them to have a meaningful conversation, offer them guidance on Social Security, I might have an opportunity to build a really good relationship with a perfect client for my practice.
And that's a good point that you bring up, is not only have they aggregated or saved up a lot of assets over their 30, 40-year career, but it's in different accounts. And then when they start thinking about their Social Security withdrawal strategies, you can't look at everything in isolation. You know, you have to figure out, if I'm going to delay Social Security, how do I make up for my income needs in the short term if I want to maximize Social Security? Or vice versa, if I take it so soon, what do I give up in the future? So LifeYield has created some technology, some software that helps the advisor go through all those scenarios.
Absolutely, yeah. That's what we're going to go through today.
Is that a good segue to go ahead and jump in and get started?
That's perfect.
All right, let's switch over to what the dashboard is that you have and show us how LifeYield works.
Yeah, so when you log into LifeYield, you'll end up on this dashboard or homepage. And the first thing that we want to go through is let's talk about Social Security a little bit more. So what I'm going to do is go through one of our sample cases here. And as we've talked about, there are quite a few tools on the market right now that I can use to take a client through and talk to them about either the consequences of filing early or if they wait and how that will change the benefits.
Yeah, there's quite a few Social Security calculator type tools that advisors have at their disposal.
And what will happen is a lot of clients out there, what they'll end up doing is they'll go to the Social Security website.
Oh, that's true.
Right? And if we take a step back and think about it, well, there's no tools that the Social Security website offers to help you optimize your Social Security. They're not in the business of helping you get as much as you can from them.
That's right.
So what we wanted to do is create a tool that's easy to use, that an investor can understand, and really compare and weigh the benefits of waiting to file for their Social Security, or in some cases, it might mean taking it early. And that all depends on the individual's health. It depends on their marital status and all other circumstances happening in their life. But with our system, we built an optimizer that can go through and compare different strategies in real time.
And that allows the advisor to provide that inquisitive questioning and data collection so that they can use that information from the meeting into a scenario like what we see.
That's exactly right. So what we've done is we've tried to minimize the amount of questions you need to ask somebody. Here we've narrowed it down to, for a couple, 18 total questions to get to this output.
That's not bad. Yeah.
It takes about a minute and a half, as long as we have some of the information available. So here what we're doing is the blue line is comparing a custom strategy for John and Jane. So I met with John and Jane and I asked them, well, what are your plans about Social Security? And they told me that they planned on filing when John turned 66, at which time Jane would be 63.
So you could just click these right in.
Absolutely.
For the years that they want to start their Social Security. Oh, and you can change it on the fly too.
So now I can change it on the fly and I can talk to them. Well, if you plan on filing right at age 62, you could expect to receive $3,345 a month. Now, this is based on the current Social Security Administration's projections.
Okay.
Those change. We update the software every year. I also haven't included any COLA benefit in here, which is another setup that the advisor can then play around with as a variable.
Okay, so it's optional that they can factor in a COLA adjustment.
Absolutely.
Okay.
Now, if I wanted to compare them both filing at age 62 to the optimal, we obviously show that they're going to wait for several years. Right below, we can see that would be 70 and 69 for the optimal for John and Jane.
Okay, so they can see the optimal age just on the same screen above the custom strategy.
Yep, absolutely.
Okay.
And now when I hover over the chart, I can see period by period that in the optimal strategy, John and Jane would be receiving $5,725 from Social Security.
I gotcha.
Compared to that custom strategy of $3,345. Now again, I can compare that if we want to go ahead and change it back to what they said they were comfortable with.
Yeah, they want to delay a little bit, but they don't want to wait until like the full maximum benefit for whatever reasons that they have. But again, the advisor can illustrate that right on here by a click of a button. They can illustrate it in real time and say, well, this is what it costs you, or this is what the benefit would be for you.
Absolutely. Yeah. And I think a lot of that is just knowledge is power, and people are looking for someone to guide them and direct them and really show them what their options are and what the consequence is. It doesn't mean that everybody's going to go with the optimal outcome.
Right.
But what it does go with is that they're looking for someone to guide them, and they're looking for help and someone who's looking out for their best interests. And I think that that's where our industry has a unique opportunity to start establishing these relationships with people who really do need their help and they've never known it. And so this is a really great opportunity for our industry to start building those relationships and helping people improve their outcomes.
Yeah, you don't have to convince me. And also, clients are empowered because they're making informed decisions. They can see the trade-offs. They can see that information and process it. No, maybe they don't want to make the optimal decision because they're just not comfortable with it. But at least that's an informed decision and not a completely irrational decision.
Absolutely.
All right, so what's next?
So some of the other things that are going to help people really understand this is if I just switch to the view of their cumulative benefits. So this really illustrates that there becomes a period where you're going to cross over where your cumulative benefit is going to outweigh for the optimal versus your customized strategy.
I see that illustrated a lot is where's that crossover point where it makes sense to do one strategy over the other.
Exactly. So this demonstrates that quite well. And what we've also done is ran a report that allows us to go in and overview this with the client, and I could actually leave them with this report, which will give them filing instructions based on the strategy they want to go with. So here what I can do is go through, we provide an overview of what we're looking at and some of the variables that we're considering. And here we just show them, this is a comparison report, so it's going to illustrate what the inputs were, and what the peak monthly increase is.
Yep.
So for John and Jane, based on their idea of filing at 66 and 63, the optimal strategy will get them an extra $1,670 a month.
Yeah, after they begin that optimal strategy. That's the difference in benefit that they would receive.
That's right. Also on an annual basis, so just making it a little bit easier to see that, that's an extra $20,000 a year. And that's really meaningful.
Absolutely it is.
Right?
You can do a lot of things as a couple, as a household, with that additional income in those years. I don't want to put the cart in front of the horse, but you have to make up for delaying Social Security. So I imagine that's on your timeline, but I don't want to put the cart before the horse on how you illustrate that.
Well, actually, let's take a look at that right now. So that's going to be one of the major questions. If I come in and I say, well, Steve, that looks great. I like the idea of waiting until 70 to file, but I don't think I can afford it.
Right. How do I get there
Right.
from 63 to 70?
Because I still want to stop working at 63. And so what we have here is if I come up and go into our income gap tool, I can calculate the delay of our Social Security, at which point now I can define a growth rate. So I've picked 4%. You can either be more conservative and dial that down, or some people are comfortable going up. Depends on really where that client is and how close they are to retiring. And then we can choose which year we want to start this income stream.
Okay.
So I've chosen the earliest year at 2034.
Well, yeah, you got to have some income in that first year. But here, with that growth rate, you're allowing the advisor to set up a rate of return on this bucket of money that provides that stable income for the client. So this is to figure out how much money you need to satisfy that income gap.
Exactly.
All right.
Now, we can also do it on the back end upon the death of a spouse, which right now there's a lot of different tools, and advisors use different strategies to help clients understand that, well, you're going to get a spousal benefit, but maybe you become accustomed to a certain level of income, and we need to replace that gap. So the other component here is defining a growth rate for the benefit replacement upon the death of a spouse.
Okay.
And so I'm going to turn both of those on. And now when we come back into the system, we'll see that these beginning and end periods have been filled in. And so at the bottom of the little pop-up here, this shows us that what we would need starting this year in 2019, we would need $279,000 in change invested at a rate of 4%, so that at that first period when John turns 62, where he plans on retiring, we can start an income payment to him of the $5,725 that they'll receive from the optimal Social Security strategy.
Yeah, so that's income from that withdrawal from that bucket of investments, and then it looks like that's what sustains them until the optimal strategy, which is age 70, age 69 that we see for John and Jane.
Exactly. So on the bottom there, as I hover over period to period, we can see here that in 2042, well, we've depleted or drawn down that investment account to just over $16,000.
Okay.
Right? And so I can see that balance period over period. So there's a small remainder left over.
Yep.
And now as we get to the end, upon the death of John, we've now introduced the concept of replacing the income for the remainder of Jane's life. And so here we can see it's just under $15,000 we'd need to set aside today at that growth rate of 4% in order to replace that income. But I can also use this as a way to introduce a conversation about annuities. When properly placed, can do a great job of replacing that income for people. If enough time is before they retire or before they reach that decision point of Social Security,
Yep.
We can place some other strategies, not just investment accounts. Also at the end, a life insurance policy can do quite well here to replace that income.
Right.
So we wanted to leave it open enough for advisors to be able to have the conversations that they need to have that's appropriate for those clients. But at the end of the day, what we wanted to illustrate here is how important it is for an advisor to establish themselves as that quarterback, that when they have the opportunity to coordinate all the investment accounts, all the insurance, and plan for taxes, they can get those clients better outcomes.
Right. It's I think a lot of focus on the first gap period, those first years. I think a lot of calculators illustrate, but maybe it's done at the loss of thinking about the terminal end of how you help with income replacement after the death of one spouse. It's nice to see that this is illustrated right here. And again, if you need to tweak things, it was just as easy to bring up the income gap tool,
Absolutely.
enter some different scenarios, and run those run those reports. That was helpful.
Here's a typical scenario that people come up with. They like the idea of going with the optimal, but that seems like a little bit too long. So maybe they agree on a middle where John's going to go with 67, Jane's going to wait till 65. That improves their outcome here where they're going to get $4,400 a month.
Right, they get an additional benefit for sure because they wait a little bit, but that changes that bucket of money amount of what they would need for the income gap substitution.
And then what I do is I come in here and I just change our income gap to go against the custom strategy. So now I can show them in order to achieve that and still stop working or start this income at age 62, what we're going to need is $140,000.
Yeah, well that makes sense, and it cuts down their capital needs, I guess, significantly. That sounds like it's close to 50% just by tweaking the Social Security by just a couple of years. So it's nice to talk about that trade-off of if you are constrained on the amount of assets that you have available, well, if you waited 2 years, you just illustrated that in 45 seconds for me. So that was really neat to see that it could just be illustrated so quickly to evaluate those trade-offs, just like we did face-to-face.
Exactly.
Clients and advisors can do that just as we did it.
Exactly. And that's what we're aiming for here, is really just to provide advisors a tool where they can quickly and dynamically answer questions for clients, show them the cost benefit of different choices, and hopefully get them on a track to have improved outcomes.
That's good. That's good. Now, I imagine there's more than just the Social Security illustrations that LifeYield facilitates. So tell me more.
Yeah, so one of the things that we introduced this last year is a system that we call Portfolio Advantage. And through that, we get to something that we call the Taxficient Score. And the first thing that I want to do is just, if I come back to the homepage here, the Taxficient Score is a tool that we've built to help measure the benefits of asset location. And sometimes when we say that to advisors, we see their eyes light up and they know exactly what we're talking about.
Yeah.
Other times, what do you mean asset allocation? And we go, no, location.
Location, that's right? That's right.
And so one of the things that we have gone out and produced quite a bit of material on is what we call tax smart, risk smart investing. And so asset allocation is really important as it relates to risk.
That's right.
I need to determine what allocation I should have you invested in order to arrive at the appropriate risk for you as an investor. Traditionally, the entire industry is focused on accounts. Right? So we started by delivering, we had stockbrokers. They were recommending individual stocks and bonds and making those direct investments. And then we started getting into an era where we introduced mutual funds and we started seeing more managed products that were all rolled up. And then it became a product delivery conversation where maybe you were out there and you were selling for a big asset management company. And then we got into this account thing, right? And we saw the evolution of qualified accounts and
401ks, 403bs.
Exactly. And
then
so
IRAs. Now you have HSAs.
Yep. And so what happens is the entire industry shifts to focus on each account. And we've all done it, right? Our compliance departments all require us to go through a certain questionnaire every time we open an account. And what asset location wants to do is we want to try and bring all those accounts together and really focus as somebody as a holistic household and make sure we're taking advantage of all the accounts they have. So the tax smart component comes in where we look at all the accounts and say what's the best location for all the investments based on that target allocation.
Yeah, so it's come up a lot in the last decade, again, with the proliferation of accounts and different assets. They spin off different levels of taxable income or just growth and appreciation. So you have to trade off long-term capital gains rates with income rates. And as the proliferation of accounts gets out there, it gets harder and harder to kind of keep everything in your brain about what's the optimal location for different assets. So this is what you're trying to address with this proposal, is to quantify and illustrate it with, I guess, the Taxficient Score, quantify how the total household can be optimally located in terms of their assets.
That's exactly right.
Easy for me to say.
The first thing I want to show is a tool that we created just to initiate the conversation. And this is what we call a quick proposal. A lot of advisors who are talking to their clients about asset location are drawing diagrams on the back of a napkin. And
Or they're making a spreadsheet.
Or they're making a spreadsheet. A lot of the time it's going to be theoretical. what we wanted to do is give you a tool that you could use really quickly and put some detailed information in about that client that's going to seem like this is about them and not just a theoretical conversation. So here we can put in their income tax rate and their long-term capital gains rate.
Yep.
And maybe I don't even have their statements yet, but through a conversation, we've identified that they have about $1 million in non-qualified assets.
Okay, so you don't need to spend a lot of time in a prospecting meeting going through shoe boxes of statements. You could just like, hey, give me a ballpark estimate of what's in these accounts. And then you also have the allocations. You got the 50% equity, 50% bonds. So again, you don't need the number to the fifth decimal place. You just need an estimate to do these illustrations.
Yeah, the quick proposal is intended to be just that, Bill. It's meant to be quick. What we wanted to do is just help you establish a conversation and really start talking about ways that your practice is going to really help benefit that client to improve their outcomes.
Got it. Right. So what do we see here from this quick illustration?
So right here, what I did is I just entered in a portfolio of $2 million. We've identified that the target allocation for this client is roughly 50% equities, 50% bonds, which we've arrived at. We've done that through a pro rata allocation across all of the accounts.
Okay.
Now, to a client in their naked eye, they'd be like, okay, this is great. We arrived at our target allocation, right? That's what we should do.
Yeah.
But that's not the most tax efficient way they could have gotten there.
So while their asset allocation looks correct, the location still offers some opportunity for improvement.
That's exactly right. And the thing that I really like about the quick proposal is that you're really going to get two outcomes. One is going to mean it's going to show us that, okay, well, the client's accounts have been located properly. Once I have a little more information and we can determine that, there's not a lot of room for improvement. And that is really valuable to establish and show them evidence that their accounts are being managed correctly and that their household is really has a true holistic view.
Good.
The other is going to be something like we see here, that for this client, they have a Taxficient Score of 59, which you can think of as about half as tax efficient as they could be on a scale of 0 to 100.
I see. So it's illustrating in this illustration, the after-tax return at that current score gets you about 6.12%. But if you were really terrible with your location preferences, you'd have that lower after-tax return with the worst score of 0. But it does show you on the other end, if you made some movements and transitions, you could pick up some additional after-tax return. Just for moving or giving a preference of assets in one account over the other.
Absolutely.
Okay.
And so, I think a lot of the time we know about this theoretically, right? It's part of our licensing.
We do. You say this type of fund should be in this account, and big growth stock should be in after tax because of the low capital gains rates. Mm-hmm. So we have these rules of thumb, but it's harder to kind of put it into concrete numbers.
Exactly.
Much of the time.
Exactly. Okay. And so what we've done here is we've tried to boil it down and quantify the benefit of having a financial advisor that really does take a holistic view and show in dollars and cents what that value adds to that relationship.
Good.
And so here on this example, by getting this client from 59 to 100, could add an additional $237,000 over the next 10 years in after-tax value. So this is money that goes back in that client's pocket that they can spend.
That's right. It's not just theoretical. They could meet some more goals. They could do legacy planning for kids and grandkids or whatever they want. I mean, that is what I guess I like to say. That's money in your pocket that you can spend. Mm-hmm. It's not numbers on a spreadsheet. This actually makes a difference with what they can spend over their lifetime.
That's right. Now, obviously, we need to go a little bit deeper.
Yeah, this is just an illustration. Yeah.
This is meant to be that high-level conversation. So what we'll do is once we've either gotten some statements from a client or perhaps we already have some of their information that we've aggregated through another piece of technology that we're using, you can turn the integration on with LifeYield, and we'll get those accounts in. I'm going to go to our portfolio section here and just go to a sample of Rick and Stephanie. And Rick and Stephanie have about $1.5 million and we've loaded those accounts in here.
Okay, yeah. So you can see that much more detailed breakdown of the portfolio allocation. It's not that 50-50 illustration that you had before.
Exactly. So here we're going to be considering a lot more granularity as it relates to the investments that they own and their overall asset allocation across these categories. Now, their target allocation, we've determined in this hypothetical scenario that it's correct.
Okay.
They have about the right asset allocation from a household perspective. But we're not taking full advantage of this Roth that they have available over here. They've been able to put about $152,000 into a Roth, and
or whatever combo of tax-free accounts they have, right?
Exactly.
Because you can illustrate like an HSA, which is a tax-free account. You can illustrate that in addition to the Roth IRA.
Absolutely.
Okay.
Yep. And then in their tax-deferred accounts here, it looks like they have some bonds. They have some passive and actively managed products here. And what we want to do is we want to go ahead and, again, optimize this. They have a current Taxficient Score of 60, and right there at the top of the screen, we show them that if you can go from 60 to 100, there's about $226,000 on the table to help improve your outcomes over time.
And again, that's not, those aren't pennies.
No, not at all.
That's real money that they get to spend.
Yeah. Obviously, there's a lot of different things that we can tweak here. If I'm talking to an existing client, I might want to come in here and show them that, hey, today we're at a 60 and here's some of the incremental improvements that we're going to work on over time to help improve this, right? The way I always like to explain it is that 100 is ideal.
If all the planets line up,
exactly,
that's as optimal as you can get.
Exactly.
But we live in the real world and the planets don't always line up.
Yep.
So I guess it's something to aspire to. But again, I think you're saying, and you're trying to emphasize, every change, positive change in your tax-efficient score, that leads to money in your pocket.
Improved outcomes, right? That's exactly it. So if I can get you from a 60 to a 62 over the next year, I've done a great job at improving your outcomes over time.
That's right.
So as you get closer and closer towards your retirement, the probability of you achieving your goals and having more money in your pocket has gone up.
Yep. And to reiterate, you're not taking any additional risk in the portfolio because you're keeping the same asset allocation and the risk profile of all the investments across all the accounts.
That's exactly right. Now, one of the things that you can set up inside this account or inside your LifeYield profile is we do have the ability to have a conversation about what we call equivalent groups. And so one example that I think most of us are familiar with is going to be taxable bonds versus muni bonds.
Okay, yep.
Right? Now, there's going to be a break-even point depending on the state that you're in.
Yep.
On what tax rate you need to have to benefit from those muni bonds. So rather than the advisor getting out a spreadsheet and trying to know that or go by a rule of thumb, what we want to try and do is you can create an equivalent group inside LifeYield, and we'll actually facilitate the swap for you, and we'll show you based on those clients' tax rates that you put in, whether or not they should own the taxable or muni bonds, and whether or not they have a balance where we can take advantage of it.
Yeah, I mean, I do this a lot in my demos where it makes my head hurt because we've already talked about asset location preferences and some of those rules of thumbs over capital gains versus real estate investment trusts that always throws off income. So you're trying to keep those rules of thumb in your head, and you're like, oh yeah, regular taxable bonds are different than my municipal bonds and their tax treatments. And now I've got to factor in what my client's federal tax rate is, state tax rate, and it just is so hard to maintain it all for just one household. Now I work with 100 households.
Exactly.
Great. It's important work to happen, but the thought of trying to run those scenarios using rules of thumb or in my head, it makes me panic a little. So I like being able to use tools that you can set up these equivalent groups and not let those rules of thumb kind of escape my memory.
Absolutely. And some advisors that are watching this, they might be thinking right now that, I'm using a rebalancing system. I'm using iRebal or Tamarack. I'm working with a rebalancing tool where I've set up my location preferences.
Yeah.
Any of you that are nodding your heads that you're doing that, you know that there's a tremendous amount of work that goes into maintaining that within your rebalancing tool.
That's right.
And what I would propose is it's about time that you had something that really helps you illustrate the benefit of all that work for your clients.
Well, that's right. It's a really good point. All the hard work in putting those models and location preferences together, a lot of times it's difficult to communicate the value to clients. Sure, you have a performance report and you have trading history, but I'm not sure that those output kind of the reports that we see here where, hey, over 10 years of time, the benefit is this improved outcome for you. That's really tangible, I think, to clients that they can see it right there. I like that as a client, in addition to the report that I might get from a rebalancing or portfolio performance solution.
Absolutely.
I like to get both.
I mean, in times of what we've kind of just recently gone through, where you have an increase in volatility, or maybe you go to have that quarterly or annual review with a client, and I think times like now is more than ever when they sit down and they want to talk about performance. And I think having more tools in your toolbox on ways to, when you do those reviews, to kind of redirect the conversation about where you're adding value is tremendous. Not to mention that if there are improvements to be made, I think the number one reason why advisors don't make those improvements is because of low cost basis holdings.
Right.
Well, in a downturn, we talk a lot about tax loss harvesting.
Sure.
Well, let's also leverage the opportunity to relocate those assets in a more optimal location. So if we need to make some sales in a non-qualified account to relocate, well, in a downturn is a perfect way to do that. And what a better way to show that to your client than how it's going to benefit them over the long term.
That's a little bit of a 2-for-1, being able to get two things out of, making lemonade out of lemon sometimes.
Absolutely. Absolutely.
So is there a little bit more detail that you want to show me out of the household illustration?
Yeah. So the next question is really, well, how do we do it? How do we make the improvements? What does LifeYield suggest? For any advisors out there that are already doing a great job with asset location and really trying to coordinate all those accounts, we're probably not going to teach you anything new other than helping you be a little bit more efficient around where you can swap out one product for another.
Yeah, efficient and consistent. You're not trying to reinvent a spreadsheet for each household. You're able to use the same tool and have these consistent illustrations.
That's right.
Good.
But what we have created for those advisors that are already doing asset location is we've created this benchmark, the Taxficient Score, which as there's contributions or withdrawals, as the account and the household change and evolve over time, the Taxficient Score stays consistent within that range of 0 to 100. If any changes happen, whether it's due to a rebalance, a withdrawal, a sizable contribution,
right,
all of those are an opportunity for us to improve the overall location of the assets and the potential outcomes for the household.
Right, so you get a liquidity event. You can deploy that capital in a location-sensitive way to optimize the different places where that is going to be invested.
Which can ultimately result in a higher Taxficient Score. So now when I sit down with my client and I can show them something that they can get, which is this scale of 0 to 100, where I show them that you were at 60 last quarter, and now we've got you up to a 68. And we've used these actions, whether the withdrawal or the contribution happened, we can show them something they understand that we're improving. And the way I like to look at it is like a credit score. Same thing. I look at my credit report and all the variables that go into that credit report, they make my brain hurt. Right? It's too much for me to try and manage and balance. But I do understand my FICO score.
That's right. Is it improving or is it going in the maybe not right direction?
In the other direction.
Yeah.
And so what we've wanted to do here is kind of break down again with the Taxficient Score, show where you're at and what we're proposing out of the best. In this case, the example that we're running is we're saying, hey, in an optimal world, there's no constraints. We should be able to get these clients to 100 over a period of time. In other cases, you'll have other types of accounts. Maybe there's accounts that are held away, right? If I'm sitting down with a client and they have a couple of accounts that are held away and we want to consider them in this analysis, I can mark them in LifeYield as held away, but it also locks it. So it says we can't make any recommendations.
Well, that's helpful.
Yeah, so that would result in our proposed portfolio being less than 100.
Right. But still, the software isn't forcing you in the illustration to say, hey, take those held away accounts and make these big changes to it. It's like, hey, I locked it down because I can't make changes at this time.
Exactly.
But it provides that planning opportunity for the future. And to reiterate the score that you were talking about with the credit score, I can see it now after working with a household for 3 or 4 years. They're like, I pay a lot of money in fees. What have you done for me lately?
Right.
It's kind of neat to be able to pull in the Taxficient Score and say, well, we started in your first year as a 60. We moved you to a 63, then a 65, and today you're at a 68. So we've been working each of the 4 years to make you more and more tax efficient. And it also comes, I guess, with that 10-year benefit discussion. It's like, that's a great way to say, we hope, as an advisor, we hope that we are providing value.
Yeah.
And here's reports that show how we're improving things. And we hope that you as a customer appreciate the value that we are adding for the fees that we charge.
Yep.
And it's no longer this lightning rod of a nervous conversation. It's actually, the advisor is very well equipped to demonstrate tangible value. And that's tangible in terms of even that after-tax, that 10-year benefit in hard dollars and cents.
Let's go through the rest of the proposal here, Bill. So we want to cover the Taxficient Score. And again, just like the previous screen, if you go from left to right, the 0 would be if you've done
you actually ignore all the location benefits.
or maybe you go out of your way to put assets in the wrong accounts.
Intentionally to make it bad, okay.
What this means is that client, again, the asset allocation for this household is consistent. We haven't changed anything. So their asset
That's right, and the risk level is the same too.
Is the same. Now with that asset allocation, they could take home as little as 5.71%.
Yeah.
If all of those assets are in the wrong accounts.
Yep.
Or as high as 7.71%. That's a pretty big margin. This client fits just above the middle at 692. There's still a considerable amount of improvement we could make to help improve their outcomes.
Yeah, look at that 10-year balance. I mean, there's a sizable difference in that 10-year balance over that time because it compounds, right? It compounds year over year, and little changes in your first couple of years become more significant as time progresses.
And that's right. So the next chart here on the screen is we show the growth over time based on each score. So obviously, if we can defer taxes longer, the growth happens over time.
Yep.
So here we show the outgoing taxes for that client to help illustrate that, well, if we can defer those taxes longer, we're going to have a larger bucket of money at the end to access and turn back into income. At the bottom of the screen here, what we do is a different way of looking at the current versus the proposed, where in the middle we have that defined target. So for this example, we use the client's current portfolio. Right? So this is their household allocation. In other circumstances, you can change the target. And so you can make that target one of your models. Maybe if it's a brand new prospect, you've determined not only is their location kind of whacked, but they also have the wrong asset allocation.
Okay. Yep.
Maybe they need to be more aggressive or more conservative. So we can make that recommendation here. So we'll show the transition from where they are to where we want them to be, and really how achievable that is and how much we can optimize for the proposal to improve their location.
So you're not completely ignoring risk. You're, like I think you said before, risk smart, tax smart.
That's right.
Okay, the check's in the mail for that one. But you're again, with that tool and illustration, you're able to incorporate both of those changes in the same tool. So the advisor doesn't have to have 2 tabs open, one for risk and one for tax.
Exactly.
Okay.
So here what we do is similar to in your financial planning software, we want to bring in the idea of pre-tax rate of return. Which is really where a lot of the conversation we've had as an industry has been when we talk to clients about financial planning.
Yeah, yep.
Location is that thing that is really going to impact how much of that pre-tax rate of return we get to take home with us.
That's right. I don't get to spend my pre-tax rate of return. I get to spend my after-tax money.
Exactly. And there's a lot of variables that go into how that's calculated. And what we try and do is simplify that and really illustrate here that there is somewhat of a predictable tax drag over time. And if we can reduce that, again, you get to defer your money longer and you get to have a larger bucket of money at the end of the day. So from here, we can run 2 different reports, Bill. We have a summary report, which is what we recommend an advisor would use with a client, which focuses on the Taxficient Score. There's also a detailed report that you can run, which goes into some of the data that we have here behind the presentation, and is going to give you some recommendations on how to implement it.
So is that what we're seeing here?
Yeah, so this is going to be the output, brandable by the firm. It would have the advisor's contact information there. The first page, which this is included in the summary report, is going to be, well, this is how your portfolio looks today.
Yep.
And this is the allocation and the balances across these 3 buckets.
Good.
And you have a Taxficient Score of 61.
Okay.
Now, 61 isn't bad. In fact, as it relates to 0, there's a pretty big improvement that you're already on track to
You're right.
realize.
They're already ahead of the game because there's some good core location preferences happening, but there may be some opportunities for more.
That's right.
All right.
If we could get you to 100, this is over here. So in this example, this is how we propose your household looks moving forward. So this is what we want to work towards. This is our goal. Taking advantage of those Roth and qualified accounts, and then using your taxable balances in a way that's going to be more strategic.
Yep. Good.
If we make all those changes, in this case, we could get them to 100, improving their after-tax rate of return a lot,
Oh, definitely.
and adding that extra $224,000.
Definitely.
Again, as we go through, just like we saw in the software, we're going to look at the growth over time. We're also going to look at the outgoing taxes over time. And below that, we start to get into the implementation. So here, again, we can compare the pre-tax rate of return versus the after-tax rate of return. And from a very high level, the target changes that would need to happen. But this is kind of a lot for us to consume, right? So if I'm going through that, what I want to identify is what's a step I can take today or concentrate on. So we've introduced this page, which we call location swaps. And this shows us, well, here's some of the most beneficial changes we can make to this client's account without having to make every single change in the book.
Oh, so look at this. You have different activities and its associated score improvement. So you don't have to take all the actions for the complete score improvement. You can prioritize them based on the maximum impact. That's what we see.
Absolutely. So maybe you, as an advisor in the real world, something, like emerging markets have a huge correction. They already have, right? Or commodities, let's say,
Yep.
if we're looking backwards. And there's a good opportunity there for you to maybe make some changes. Well, in this report, you can come in and find either the commodities or emerging markets and what an equivalent swap could be. So I could use that to help improve my tax-efficient score. Or alternatively, maybe I say that my motivation is that I want to come in and improve the tax-efficient score. So what we're going to do is prioritize that action and show you what the most valuable changes you can make right away are. And so inside the report here, just looking at the first line, we show that by taking some of these actively managed, maybe a mutual fund that you have, this large cap mutual fund, and we want to sell that out of our taxable account, and we want to buy some intermediate muni bonds. We're not changing the balance in the account.
Correct.
We're not showing contributions or withdrawals in or out of an account.
That's right. It's all inside the account.
Right. And in our qualified account, what we're going to do is we're going to buy back that large cap, that actively managed mutual fund, and we're going to sell out of those intermediate muni bonds, those taxable bonds that were there previously.
Yeah.
And again, some advisors will think about location and they think about yield versus potential gains and sheltering long-term capital gains versus yield. And what our algorithm is designed to do is, again, consider your client's tax rates and consider the assumptions behind each category, which the advisors can customize. Mm-hmm. So they can come in and they can tell us what they think the expected growth rate of that actively managed large cap category is, and what the dividend is. And our algorithm is designed to get you the best after-tax rate of return. And so sometimes that might mean holding taxable bonds in a qualified environment, and other times it might mean that we need to swap it out and move it around.
Interesting.
Right? So rather than trying to have all that in our heads, let's use software as a way to optimize that, and software that's going to help me improve the conversations I have with my clients.
And again, I like that each move or these improvement in scores are kind of itemized, because again, if I tried to do that in my head, you go with the rules of thumbs of certain assets should be in different accounts, but I'm not sure I could come up with an illustration in my mind about what it means in terms of a bottom line impact to the client, because maybe it's not always practical to take these actions all in the same year.
Right.
And this type of itemization helps that discussion of, well, here's what we're going to do this year. because you're already in a high income thing. We don't want to trigger so much in terms of additional income. But next year, you're going to go on a 6-month sabbatical. So you're going to have low income. Now, all of a sudden, we can take the taxable action, but it has a high Taxficient Score improvement and execute that. That's a really good, again, reiterates the value of the conversation with an advisor that is augmented with the algorithm and the technology, rather than giving 100% of it over to the algorithm, which says, hey, make all these changes and do it ASAP, because that's the largest dollar amount change. But now the advisor can kind of interject and say, yeah, if you're thinking about taking time away from work, if you're thinking about reducing an income, we can take advantage of that. But that's your choice as the client. You're not forced to do anything by an algorithm. The advisor is able to guide the conversation.
Exactly. That's exactly right. And you know, a lot of the time people think about this as only something that matters during accumulation, but that's not true. If I go to retire, it's not like I take all of my retirement accounts and turn them into cash. Right? They still sit and they're still at work for me. Sometimes my allocation changes, but overall my assets still need to be properly located. My income tax rates might change, but at the end of the day, Bill, if I have choices between the investment products I use and I take the less tax efficient products and I can shelter them in qualified accounts, my clients are going to get a better outcome.
That's right.
The longer I can do that, the better, more valuable that outcome gets. And so the next thing that we're working on is going to be a withdrawal tool that helps us coordinate across all of the clients' accounts how to most strategically and most tax efficiently take a withdrawal.
Yeah, I was just going to say, we've focused a lot on accumulation and what you have, but you open up a whole new can of worms when you're taking money out of accounts. What order do you take them out in? How does it move the needle on your triggering these tax brackets? And I know that there's tools that exist that try to illustrate that. And it's nice to hear that you're already on the roadmap to integrating it into the solution that helps with Social Security as well as the accumulation. That'll be even more comprehensive than what you just showed us today.
Exactly. That's where we're going.
That's great. Is there anything else to address and talk about before we wrap up?
No, Bill. I think that keep an eye out for LifeYield going down the road, as again we introduce Income Advantage, which is going to be a product suite built right into this same platform, which will allow you to take dynamic withdrawals across all those accounts. Again, simplifying the measurement of improvement using the Taxficient Score, and really illustrating for a client that there's an infinite amount of ways that we can work across all your accounts and achieve an income goal that you have. But some are going to be more tax efficient than others. So what we really want to do is add clarity there and show those clients exactly how we're helping assist them to improve their outcomes and get the most out of the investments and the hard work that they put into retirement.
Okay, so for our advisors who are watching, where can they sign up? Where can they get more information about what's coming with the income analyzer from LifeYield? Where's the best place that they can go to sign up and get more information?
Absolutely. So you can go to lifeyield.com and you can sign up directly for our newsletter and everything else. Visit fppad.com/LifeYield to also view this video, see details about upcoming events with LifeYield, as well as receive a discount. So for all FPPAD viewers, we've put a coupon code in there.
Nice.
And you're welcome to sign up. If you want to learn more information, there's also, you can request to do a demo. And one of our product experts will jump on the phone with you, walk you through an overview of the product, and answer any questions that you have. Really, we encourage everybody to kick the tires. It's something that I think will really help enhance the relationships that you have and the conversations you're having with clients. The thing that we've heard the most about recently is, again, redirecting the conversation when you have these client reviews away from performance. All your clients want to hear about performance. They want to know how they're doing.
Sure.
But I think underneath the covers, what they really want to know is where you're adding value.
Well, and I'm a client as well, and I know that I cannot control performance. It's out of my control. You know, and we can do allocation and try to overweight or underweight different sectors based on what we're thinking of the time. But for the most part, a lot of those returns are beyond my control. But the whole idea of tax location preferences and account optimization, those are absolutely things that we all can control. And now they're illustrated in a very clear manner. We can take action and we can see some of those tangible benefits of following through with that advice.
That's it. That's right.
Well, hopefully this demo was more than enough for our viewers to get a taste at what LifeYield offers, what it's capable of doing, and a lot of the material that can be presented directly in front of clients as well as prospects.
Yeah.
So thank you for taking the time to show us how this all works. I'll put up on the screen one more time. You can sign up for more information at fbpad.com/LifeYield. That'll forward to the LifeYield page. We'll have this video there, have more information. You can sign up for a demo and that ever so coveted coupon code for the FBPad viewers. But I think that wraps it up. This was really insightful. I appreciated learning a little bit more about what LifeYield is capable of doing. So Steve, thank you so much for taking the time to show us what LifeYield is able to do. So if you like this video, you like this demo, please hit that thumbs up button on the FBPad YouTube channel. Subscribe to the FBPad YouTube channel because I will be back with more fintech companies for product demos. But until then, bye for now.